Hey everyone, welcome back. Ready for another deep dive?
Definitely. Always excited to dig into some interesting investment ideas.
Well, today we're taking a look at ETFs. Specifically, this article we found called 7 Vanguard ETFs to Buy and Hold Forever. Going to see what they're all about, whether any of them might fit into, your long-term investing strategy.
Sounds like a plan. ETFs are definitely having a moment.
For sure. And just a quick reminder for anyone who's new to the ETF game, basically they're like a basket of stocks, right?
Yeah, exactly. You can buy or sell them just like a single stock, but instead of putting all your eggs in one basket, you're getting a little piece of lots of different companies.
Instant diversification. I mean, that's got to be appealing to pretty much any investor.
Makes life a lot easier, that's for sure.
Now, this article specifically focuses on Vanguard ETFs. And, they're famous for having those super low fees.
Yeah, Vanguard's known for that. It can make a big difference over time.
Absolutely. So, the 7 ETFs on our list today are VOO, VTI, VT, VIG, VOOG, and VUG. Whew, quite a lineup. But before we get lost in the alphabet soup, let's start with the ETFs that give you the broadest exposure to the market, those core holdings.
Right, the foundation. So we've got VOO, which is the Vanguard S&P 500 ETF, and then there's VTI, the Vanguard Total Stock Market ETF.
Okay, so let's break those down. I guess starting with the S&P 500, everyone's heard of that. But what does it actually mean to, invest in it?
So think of the S&P 500 like an exclusive club. 500 of the biggest, most well-known companies in the U.S. When you invest in VOO, you're essentially buying a teeny tiny piece of each one of those companies.
Ah, okay. So it's like instead of trying to pick individual winners, you're betting on the overall success of the U.S. economy, kind of.
Pretty much. It's a way to get broad exposure to the market without having to research hundreds of individual stocks.
Makes sense. And what about VTI? How's that different from VOO?
So VTI takes it a step further. Instead of just those 500 big companies in the S&P 500, it includes almost every single publicly traded company in the U.S.
Whoa, that's a lot of companies.
It is. So you're getting exposure to large, mid-sized, and even small companies across all different sectors. It's truly a way to capture the entire U.S. stock market in one go.
I like it. It's like the ultimate set-it-and-forget-it investment for the U.S. market. Now, the article mentions something called an expense ratio. Can you explain what that is? Because I feel like a lot of people might not know about that.
Definitely. It's a really important concept, especially for long-term investing. Basically, the expense ratio is the annual fee that you pay to the ETF provider. It's a tiny percentage of your investment, but trust me, over time, those fees can really add up.
Oh, yeah, definitely. Like death and taxes, those fees are always there.
Sadly, yes. So let's say you have two ETFs that have similar returns, but one has an expense ratio of 0.10% and the other has an expense ratio of 0.03%. That seemingly tiny difference, like 0.03%, can add up to thousands of dollars in fees over, decades of investing.
That's a good point. It's like those tiny little fees, they're sneaky, but they can make a big difference in the long run. So choosing an ETF with a low expense ratio is kind of like getting a head start in the investing race.
You got it. And that's a big reason why Vanguard is so popular with investors. Their ETFs often have the lowest expense ratios in the industry.
Right, which is exactly why this article focuses on them. So getting back to VOO and VTI, what are their expense ratios looking like?
Super low. Both have an expense ratio of just 0.03%.
Wow, that's incredible.
Right. And the article also mentions their average annual returns. Over the past 5 years, VO had an average annual return of 14.76%, and over the past 10 years, it was 13.90%.
Not too shabby. What about VTI?
VTI wasn't far behind, with an average annual return of 14.07% over the past 5 years and 12.56% over the past 10.
Those are some pretty impressive numbers. But, the classic disclaimer, past performance is not necessarily indicative of future results, right?
Put down, remember that. The market can be unpredictable. What goes up can also come down. Those are averages over a specific period of time, and there will always be ups and downs along the way.
Makes sense. It's like you can't just assume things are going to keep going up forever, right? Got to be realistic.
Exactly. Investing always involves risk, and it's important to be prepared for the long haul.
Okay, so let's say someone's listening and they're thinking, okay, this is all great, but what if I want to invest in companies outside the U.S.? Is there an ETF for that?
Absolutely. That's where VT comes in. VT is the Vanguard Total World Stock ETF. It's like VTI, but instead of just U.S. companies, VT invests in companies all over the world. We're talking established markets and emerging markets.
So it's like taking your investment portfolio on a world tour.
Exactly. You get exposure to all sorts of different economies, industries, and growth opportunities. It's a great way to diversify your portfolio even further.
Love that. Now, how does the expense ratio for VT compare to the other two?
It's still super low, don't worry. Just a tiny bit higher at 0.07%, but that's still incredibly low compared to a lot of other ETFs out there.
That's amazing, seriously.
And in terms of returns, VT had an average annual return of 10.16% over the past 5 years and 9.35% over the past 10 years.
Okay, so a bit lower than VOO and VTI. But when you consider that you're investing in companies all over the world, that's still a pretty solid performance.
Exactly. It's all about finding the right balance for your own investment goals and risk tolerance.
Okay, so we've covered the ETFs that give you broad exposure to the market. But what if you're looking for something a little more specific? Like, what if you're interested in companies that pay dividends? You know, those lovely little checks that show up in your account.
Dividends. Can't go wrong with a little passive income. For that, we have VIG, the Vanguard Dividend Appreciation ETF.
Okay, tell me more about this dividend appreciation thing. How's it work?
Well, imagine you own a piece of a bakery that keeps giving you a bigger and bigger slice of cake every year. That's kind of what dividend appreciation is like. VIG invests in companies with a really solid track record of increasing their dividends year after year.
Okay, that makes sense. So it's not just about companies that pay dividends, it's about companies that keep increasing those dividends.
Precisely. And that's often a sign of financial health and stability. These companies are doing well enough to share more and more profits with their investors.
I like it. It's like those companies are sharing the wealth. So what kind of returns are we looking at with VIG?
The returns have been solid. Over the past 5 years, VIG had an average annual return of 11.63%, and over the past 10 years, it was 11.40%.
Interesting. So not quite as flashy as those broad market ETFs, but those consistent dividend increases could be really appealing for some investors, right? Especially if you're looking for that steady stream of income.
Absolutely. It all comes back to your individual goals and risk tolerance. Now, are you ready to shift gears and talk about growth ETFs?
Let's do it. Bring on the growth. What have we got?
Okay, so for growth, we've got VOOG and VUG.
All right, so VOG and VUG. What's the difference between these two?
Well, VOG is the Vanguard S&P 500 Growth ETF. It focuses on companies within the S&P 500 that are expected to grow quickly. Think tech companies, healthcare companies, innovative companies, disruptors, that sort of thing.
So it's like the cream of the crop, growth-wise, but just from within the S&P 500. What about VUG?
VOG is the Vanguard Growth ETF, and it casts a wider net. It includes growth companies of all sizes across various sectors, so not limited to just those in the S&P 500.
Got it. So VOG is like the all-star team of growth companies from the S&P 500, while VUG is the whole league of growth companies, regardless of their size or what index they're in. Is that a fair way to put it?
Perfect analogy. But remember, with growth often comes higher volatility. These ETFs could have bigger price swings than the others we talked about.
Yeah, that's a good point. Risk and reward, they often go hand in hand.
Exactly. So you got to be prepared for a bit of a roller coaster ride with these growth ETFs.
So let's get into the nitty-gritty. What are the expense ratios and returns looking like for VOG and VUG?
Okay, so VOG has an expense ratio of 0.10%. VUG is a bit lower at 0.04%.
Okay, so still pretty low, all things considered.
Oh yeah, definitely. And as for returns, VOG has been on a tear lately. Over the past 5 years, it's had an average annual return of 17.37%, and over the past 10 years, it's been 15.19%.
Wow. Those are some serious gains. What about VUG? Any numbers on that one?
Unfortunately, the article didn't provide VUG's 10-year return.
Interesting. Maybe something to dig into a bit further?
Definitely. It's always a good idea to do your own research.
For sure. Now, before we wrap up, any final thoughts or words of wisdom for our listeners who are thinking about diving into the world of ETFs?
Well, I think the main takeaway is that there's an ETF out there for pretty much everyone, no matter what your investment goals are. You want broad market exposure? Go for VOO or VTI. Want to invest globally? Check out VT. Want those steady dividend payments? VIG is your friend. Looking for high growth potential? VOOG and VUG might be up your alley.
So many options. It's like a buffet of investment choices.
Exactly. And don't forget about those expense ratios. Even a small difference in fees can really impact your returns over the long haul, especially if you're holding these ETFs for years or even decades.
Right. Those tiny fees can really sneak up on you.
They sure can.
So I guess if you're listening and thinking about adding some ETFs to your portfolio, the first question to ask yourself is, what are your goals? What are you hoping to achieve with your investments?
Absolutely. Once you know your goals, you can start figuring out which ETFs align with them. And of course, do your own research. Don't just rely on one article or one podcast.
Multiple deep dives, that's the way to go.
Exactly. Read different perspectives, compare the holdings of different ETFs, look at their expense ratios, their track records, and most importantly, make sure you understand what you're investing in.
Couldn't have said it better myself. And remember, folks, this deep dive is just a starting point. The world of ETFs is vast and constantly evolving. There's always something new to learn. So keep exploring, keep learning, and keep building that financial future you've always dreamed of.
Couldn't agree more.
All right, that's it for today's deep dive. See you next time.
See you then.
Bye.
Bye.